Hey everybody, Paul Craig Roberts is back with us today, just in the nick of time, since everybody is wondering what's going to happen next with bank failures. Are we out of the woods? Will it be contained, or is this just the beginning? Paul has a long record of expertise in financial matters. Assistant Secretary of Treasury under the Reagan administration, has kept track of financial doings and misdoings all these years. So, Paul, what is the situation? Do you think this will spread?
Uh, no, I don't think the Fed can afford that. The banks that fail so far, they fail for sort of specific reasons. Two of them were connected to cryptocurrencies heavily. It seems that the bank in Silicon Valley was heavily invested in treasuries or in bonds, but treasuries before the interest rate rises. And so the value of the bond portfolio on their balance sheet has gone way down. And this meant that their liabilities were larger than the assets. And so people were withdrawing the deposits, particularly those deposits in excess of the insured amount of $250,000. Apparently, a number of the depositors were firms with large payrolls. So, faced with not being able to make a payroll if the bank went down, they were grabbing deposits. So, those are sort of the basic explanations for the individual three banks so far that have failed. Republic in New York, the Republic Bank has been having some bad publicity, but I don't know that that one will fail. Once the Fed announced that it was providing cash to all banks to meet withdrawals, and when the Treasury Secretary announced that the protection of deposits extended to all depositors, not just to insured depositors. Now, that doesn't mean the crisis is over, because that depends on whether the Fed continues its mistake of raising interest rates. Because, Larry, the general problem, what the real problem is,
Right.
is that the Fed's higher interest rates is pushing all the banks into insolvency. Because as these interest rates go up, the value of the financial assets on the bank's balance sheet are going down. And so the higher interest rate policy of the Fed is simply making the banks insolvent. Well, why the Fed didn't know that before it began raising interest rates, I don't know. I don't know why they didn't know that.
Yeah, well, Paul, as you point out in your article about banking troubles on the horizon in today's postings on your site, you point out that in the past 14 months, bank reserves have declined $1.3 trillion. So even though they're being propped up now, they're going to lose some value. Now, bank runs sometimes start in, at least in part, and sometimes in large part, by panic, whether it's based on reality or not. So, could we be looking at some panic rippling through the system and snowballing from there?
Not if people believe what the Fed and the Treasury say, which is the Fed says, the whole reason the Federal Reserve was created in 1913, was so there would be a lender of last resort. And now what that meant was that they didn't want any more bank failures caused by people being worried about the money and rushing to withdraw. So the Fed with the 12 regional banks were established so that cash could be shipped really quickly to any bank in trouble. So there would be money there to meet the withdrawals. Otherwise, you see, the bank's money is out in loans. Well, in those days, they were real loans. They weren't financial instruments that you could dump on the market. And so you'd have to call a loan, but how's the farmer going to do that? His crop's not in, and so on and so on. So now during the Great Depression, the Fed failed to do what it was established to do. It didn't provide the reserves to the banks.
Right.
And so the bank collapsed anyhow. Well, what the Fed announced Sunday was we are going to be sure the banks have all the cash they need to make the deposits. So this stops the banks from trying to sell financial assets that are depreciating because so many people are trying to sell them to raise the cash to meet the depositors' demands. Well, it stopped that process. Well, that's one of the things I said the Fed should do. And the other thing I said they should do, they also did, and that was that all deposits are protected.
Yeah.
And so, but you see, Larry, this doesn't mean the problem has gone away, because there are two bigger parts of this. And one is what I was describing before your last question, and that is that this higher interest rate policy puts every bank in jeopardy because their portfolios are devalued when interest rates rise. They're holding bonds. Well, every time the interest rate goes up, price of bond goes down. They're holding all kinds of, not all the banks, but some of the regional banks and certainly the large banks, they're holding all kinds of derivatives on currency plays, on interest rate plays, and probably still on mortgage. Well, those derivatives were all put in place when interest rates were lower. So when it's time to reset and there's higher interest rates, then the value of the derivatives goes down. So there's that problem. Now, there's yet another problem, and it's so far unmentioned. I think I mentioned it. The 5 big banks have most of the derivatives. That's the 3 New York banks and the 2 California banks. Now, the New York banks, they have a multiple of the derivatives that the California banks have. But still, there's a lot of derivatives there. Like one of the New York banks, believe it or not, one bank has $55 trillion of derivative exposure. Now, Bank of America only has 20 trillion and Wells Fargo only has 12 trillion. But the New York banks are like 35 to 55 trillion each. Now, I added the figures up, and guess what? 5 U.S. banks have $188 trillion of derivative exposure. That is twice the gross domestic product of the entire world. Well, now I saw where the Treasury Secretary said we have a resilient, well-capitalized banking system. Well, how in the world can a bank with 5 banks having derivative exposure twice the gross domestic product of the entire world, how can they be capitalized for that risk? They can't possibly. Their capital is somewhere down, 100 billion, 400 billion. and yet they have risks in the trillions. So this is the question, how is this possible? Now, these are figures that are published. They seem to be official figures. I think I gave the link to them in my article today. It may have been the Federal Reserve Bank of St. Louis. I can't remember. But these are official figures. Now, just ask yourself, one of the big banks has got like $400 billion of capitalization and has derivative exposure of 55 trillion. Well, how is that capitalized, Larry? I don't understand it. I don't understand how anything could happen like this, that 5 banks have derivative exposure twice the size of the world GDP. It makes no sense. So it does, in other words, it seems the risk is just outlandish, because if just a tiny bit of that derivative exposure goes bad, that goes to capital. Well, it's gone. The bank's gone. So I don't know how this is going to play out. Now, I know what to do about it. And that is, you have to return to Glass-Steagall.
Yeah. Yeah, let's review Glass-Steagall for the viewers that may not be familiar with it. That was put in place after the crash in '29, coming out of the Great Depression. It was to separate investment banking from commercial banking, so banks wouldn't become casinos. Now, that was put in place, in
33.
33. It worked well for over 6 decades, and then
66 years.
And then the Clinton administration came along, and in 1999 they yanked it. They were talked into it by lobbyists who said that it'll help expand banking in the economy, blah blah blah. But it had just the opposite effect. So why don't you tell us about that, Paul?
Yeah, it was Phil Gramm, the Republican senator of Texas, that led the push. Obviously, the commercial banks wanted to be able to do the same things the investment banks were doing, because they made a lot more money. And the Glass-Steagall Act didn't let commercial banks do that. They could lend based on deposits, but they couldn't speculate based on them. So, and then we had Phil Gramm. He was sort of a free market economist, Republican, former economics professor. He was a senator, and he was the leader in the Senate for this effort to repeal Glass-Steagall. And you have to remember, when Alan Greenspan was the Federal Reserve Chairman, which was, I think, a few years after this, he said, of course, we don't need to regulate the markets. The markets are self-regulating. Well, I thought at the time it was very curious, because Greenspan said that he was chairman of the Federal Reserve. And if he says the markets are self-regulating, then there's no reason for the Federal Reserve. You see, there's no reason for the Federal Reserve. So he's saying, abolish my job, abolish the Fed. Nobody bothered to point that out, because it was a lot of hype. And I don't really think the Clinton administration was responsible for it. Maybe they were, but they certainly went along with it. Yeah. And so what this meant now was that commercial banks were investment banks. And this meant they had deposits that they could use for speculative events, whereas the investment banks were, at that time, private companies. It was the money of the partners that was serving as the speculative funds. the investment banks didn't have deposits from people to use. It was the partners' money. I think it was the Solomon Brothers was the first investment bank that went public.
Mhm.
And I think that was in the 21st century.
Yeah.
I think, yeah, it was 21st century, it went public.
So, yeah.
But so when they repealed Glass-Steagall, it let the commercial banks use depositors' money for the kinds of risky activities that investment banks engaged in with their own money.
Yeah. That was other people's money. Yeah.
Yeah. Well, this, of course, was disastrous, and we already had one a crisis that resulted from this. It started in 05, 06, 07, blew up in 08. Michael Lewis's books, he wrote books about this, Liar's Poker, The Big Short, The Flash Boys, is showing the utter stupidity that the repeal of Glass-Steagall resulted in.
Well, what they did was because of what happened after the banks went wild and started acting like casinos, they put in the Dodd-Frank
Dodd-Frank
and Consumer Protection Act in 2010. But the way I understand, there were so many loopholes in it that it really didn't fix what was lost with Glass-Steagall.
No, of course not. What it fixed was, you see, the result of the bailout was everybody got mad. What'd you bail out the banks for?
Right.
So what they had to fix, and what Dodd-Frank or Frank Dodd, whatever it's called, what that did was it said, well, there can't be any more bailouts, but the banks can seize the depositors' money to bail themselves out. So any money above the insured amount, the bank, if it's in trouble, can seize your account and use that money to meet its liabilities. So this, in other words, what this legislation, this fix did, it created the conditions for bank runs.
Yeah.
Because anybody with a large deposit, which of course in a regional bank or a larger bank, it's going to be corporate payrolls. They're going to be larger than $250,000. And so they're not, if this payroll gets seized, they can't pay the workforce. So what this legislation did was to create conditions for bank runs. And that's what was the danger of these two bank failures, these three bank failures, that everybody would say, oh my God, my bank's going to fail, let me get the money.
Yeah.
They would have all failed. So that's in other words, that legislation was another terrible mistake, and they should repeal that instantly. And then they should tell all the commercial banks, particularly the five big ones, that look, you have to spin off your investment banking operations from the commercial bank. It's got to be a totally different bank, and your commercial bank deposits have to be insulated from investment banks. Well, I think that would probably kill the kill the big banks from being investment banks, because the money that they use, they wouldn't have anymore. The deposits. And so the Congress and the neoliberal economists wouldn't have to eat crow by reenacting Glass-Steagall. You could just do it this way, that the banks have to split their operations and insulate deposits from the investment side. That would do it. And of course, they should repeal instantly this Dodd-Frank thing, because it guarantees bank runs the minute there's any trouble.
But realistically, Paul, what are the chances that Dodd-Frank will be repealed and Glass-Steagall will be reinstated?
It depends on how serious policymakers are, and it depends on whether they got a real fright. And of course, it depends on whether this is over.
Yeah, that's a big question.
Yeah, because as I said, the policy of raising interest rates is ruinous for the balance sheet of the banks.
Well, in fact, Paul, the Fed is meeting this month, I think on the 21st or 22nd, to decide on the next interest rate hike. And they've already been talking about not moderating it in the past two hikes or three, which was just 25 basis points, but now 50 or even 75 basis points. So that's going to add fuel to the fire, wouldn't it?
Yes, but you see, they said that before this outbreak.
Right.
Now, if they go ahead and do that, they're going to produce more failed banks.
Yeah.
It means, the ones that fail are the ones with the most exposure to decline in the values on their balance sheet.
Mm-hmm.
So if they've got instruments that are the timing being such that they had the maximum drop from this rise in interest rates, they'll go first. Or if there are more banks who had funny kinds of situations which made them more risk, they'll go first. So I think if they do raise those interest rates, they're going to start this over again.
So you think most probably they're going to back down on the interest rates. They're not going to raise them that high, or maybe even forego an interest rate hike this month?
I think they're going to have to start lowering them.
Yeah. Now, Paul, in your article, beyond just bad policy with yanking Glass-Steagall and Dodd-Frank taking its place, beyond that, you mentioned that there's a possibility that, quote, darker forces are at work, and you say that the five big banks, knowing that they are protected by the Fed, regard bank failures as opportunities to buy up assets for pennies on the dollar. The three New York banks, which you mentioned, who control the New York Fed, the operating arm of the Federal Reserve, might even have their greedy eyes on the Bank of America and Wells Fargo.
Yeah, it's entirely possible. I mean, when you read Michael Lewis, you see these people it's like mafia gangs. And look, just think about the terrible financial crisis he went through, 15 years ago. What happened? Well, there were very large regional banks like Wachovia. It was a North Carolina based bank, but it was Wachovia, a great big bank. It was all over. It was my bank down here, I think. So what happened? They got in bad trouble. Who ended up with them? Wells Fargo.
Yeah.
So now all the Wachovia offices around here are Wells Fargo. All of the big banks expanded as a result of the financial crisis. They all came out bigger.
Yeah.
They were able to buy up all the other banks. And so every time that happens, the banks that are too big to fail get even bigger. Well, now, what would they really like? I mean, just imagine if they could get the assets of Bank of America and Wells Fargo, this would be great. So there'd only be three banks. You see what I mean? And the New York banks are cozier, and as I understand it, now it may have changed since I knew this, the trustees or directors of the New York Fed are the executives of the New York banks. So who do you think is controlling the policy?
Well, Paul, you say you wrap up your article by saying that if the Federal Reserve has any intelligence, this signals the end of the rising interest rates. Inflation, now this is an important summary here. Inflation, you say, would have to be brought under control with supply side, not demand side policy. Now, translation is what the Fed has been doing to bring down inflation is raising interest rates to shrink demand and cause all kinds of financial disruptions, such as massive layoffs. So you're saying it should be just the opposite, increase the supplies, and the inflation would drop then, rather than compressing the economy so nobody could afford anything, correct?
Correct. You see, this is a supply-induced inflation. It was caused by the lockdowns and by the Biden administration's sanctions on Russia.
Mm-hmm.
This busted up supply relationships. It busted up supply chains. And still now, a lot of things you can't get. You have to wait and wait and wait. So the Fed was mistaken thinking that this was inflation caused by people spending too much money. It was caused because the lockdowns and the sanctions yanked supply out from under the economy. Yeah. So they should be, you see, this is a lesson that we tried to teach the Fed in the Reagan administration. I used to meet every weekly with Paul Volcker, trying to explain to him the difference between Keynesian economics and supply side economics. He was too dense to get it. He never understood. Well, another reason people didn't learn this lesson was the supply side policies did not come out of academia.
Yeah.
So the neoliberals didn't have a stake in it, and they were being shunted aside by it. So they were jealous, envious, and mad, and decided to demonize it, or, tax cuts pay for themselves. That was what they claimed we were saying. Of course, none of our forecasts showed that. And so the economics profession, the policymakers, once Reagan was gone, they didn't learn the lesson. That's how we cured inflation, was by changing the incentives so supply went up.
Yeah.
Well, they need to find a way to do that again. You see, one of the big disasters was the offshoring of American manufacturing.
Yeah, a big effect there. And
another big disaster is the financialization of the economy. Banks no longer, certainly the big ones, they no longer lend for new investment or new business. All the bank loans go for purchasing existing assets,
right,
turning them into mortgage-backed bonds, derivatives, and they go into financing insurance on derivatives and things like this. Well, this is not productive.
Yeah.
It does nothing for the economy. It just puts more and more risk into the financial system. So, we should be attacking it to stop the behavior of banks and tell them, look, if you're a bank and you're taking deposits, you're supposed to be financing real investment. And we should take these kinds of steps that put the economy back together so that it grows in real terms. And we have an abundance of productive capability everywhere, and it's easy to increase supply, and you don't have to wait forever and pay through your nose in the meantime and keep your labor force while you're paid, while you're waiting for things to arrive. And it's absurd the way they've got the economy structured.
Well, Paul, As they move towards 2024 and Biden's possible bid for another term, he's moving to the center. Now, whether it's largely lip service or not, I don't know, but he's putting out all these positions now that are a lot less left than they used to be, obviously in the interest of getting reelected. I don't think he has any conviction behind him or cares either way. It's just a matter of getting elected. So do you see, at least because of the political advantage for Biden and his minions, that they will be moving towards more sensible policies economically and otherwise?
Well, I don't think it's a unique situation where a president has any influence over policy. Now, we had it in the Reagan administration because Reagan was a very good advocate. And we had the problem of stagflation, and the liberals and the Keynesians had no solution. And we were the only ones that had a solution. There wasn't anybody, we had no competition. So that's how we were able to do this. Well, really, control is more in the hands of the Fed. And it's in the hands of lobbyists. So once Wall Street convinced all of the manufacturers that they had to go offshore, or Wall Street was going to finance takeovers of their enterprises, it is not a presidential or an administrative or congressional decision. So I think at this point, the Fed needs to take leadership and say, well, we've tried all this notion of the markets being self-regulated, and we found out we were wrong. So we've got to restore some kind of regulation that gives us the stability that we had for 66 years with Glass-Steagall. So the whole, and this means that all of the neoliberals and the libertarians and everybody has to admit that things have to be regulated, particularly when they can produce derivative exposure twice the size of world GDP. And so we can hope that that the Fed now understands, raising interest rates, we should have known it was going to hurt the balance sheets of the banks. Why didn't we know that? Any accountant would know that, and we're supposed to be real smart people.
Well, Paul, obviously they did know that, unless they're total idiots. But they knew that, they ignored it because they're looking for what they thought would be a more rapid fix, and hell be damned what happens down the road. That's the way I would interpret it. Do you see it that way? I mean, they'd have to know that this was.
I don't think they knew.
Really?
Yeah, because they're still thinking in Keynesian 20th century terms. Oh, inflation. How do we fight? Well, we have to prevent wages from catching up with prices. How do we keep wages from rising to catch up with price? Oh, we throw everybody out of work. We raise interest rates, cut off credit. People can't live on credit anymore. What about the 40% of the population that live that way? What happens to them? They don't think about these things.
Well, Paul, then I would ask if the same blindness applied when they were yanking Glass-Steagall. I mean, did they really not see that the banks would go wild, or were they just giving in to the money and the influence of the big banks and the big investors? I mean, in other words, didn't they know better even with Glass-Steagall?
I think to answer your question, Larry, both. They gave in to the money and the lobbyists, and they were convinced by all the propaganda that markets are self-regulated, that government's in the way. Government is in the way. You know, we had a lot of that kind of thinking even from Reagan, but it didn't get loose. I mean, we didn't let it loose,
Yeah.
but it continued, and later in 1999, Reagan's gone, it got loose. That's when they repealed Glass-Steagall. And like I say, it was a free market economist who was in the Senate, Phil Gramm.
I mean, that's
he
like
wasn't solely responsible. It was kind of like it's kind of like the same thing that happened with the neoconservatives, where the opportunity came when the Soviet Union collapsed. So they could say, oh, now we have world hegemony. So it's changed our foreign policy. So now we're in war in Ukraine, establishing our hegemony over Russia. Well, so both things happen. There are material interests, and then there's some sort of an ideological or intellectual basis, and they come together. And so together they're powerful. It's a force. It's kind of like if you look at the Biden administration, what was really the theme of the Biden administration? Well, this is the first non-white man administration. We got all these women, we got all these blacks, we've got these transgendered people, we've got lots of homosexuals. And so it's a rainbow. So the whole emphasis is on this sort of woke rainbow world. And if you look at all the representatives, that's what they present. They present this sort of rainbow appearance. This is the new America. And then, well, it's really nonsensical.
Well, you know, some commentators have noted that have concluded that Silicon Valley and other banks were infected with woke administrators and officials who were incompetent. And that was part of the reason why it went under. But wouldn't it have gone under anyway, even if you had competent officials there, because of the lack of proper regulation?
It would have gone under, yes. I mean, I'm sure the lack of competence counted, because it meant even the bank didn't realize. But all of them will go under because of the policy of higher interest rates if it continues. Because once again, they have assets on their books and they have liabilities. And if the assets fall below the liabilities, they are insolvent. So the assets are interest rate sensitive, particularly on the leverage they've got.
Yeah.
You see what I mean? Look, again, the site is in my article this morning. It shows you the derivative exposure of the 5 biggest banks.
Yeah.
If you got a bank and it's got $400 or $500 billion of capital, that sounds like a lot, but they got derivative exposure not of 400 or 500 billion, but 55,000 billion. That's what 55 trillion is. It's 55,000 billion. Well, your capital is a tiny fraction. 450 is a tiny fraction of 55,000.
Yeah.
And so this is the problem. The woke stuff, they were all stressing we're leaders in diversity. Well, when you hire people for those kinds of reasons and not for merit, you're not going to you'll be lucky if you get competent people, because once you're saying we want diversity, then that means at all costs. It used to be we want competence. And it worsens it. You're right to bring that up. It's important. The human capital in the bank is less. The people are less aware. They're less likely to say, wait a minute, something's wrong. What's wrong? How'd this happen? What can we do? But it's a mess. We'll see if the Fed in this meeting raises interest rates. I would think it's going to start over, maybe not immediately. You know, when you read Michael Lewis's books on the Wall Street crash, the last one we had, you see this stuff was going on for several years before it just became unmanageable.
Yeah.
There were really only 3 or 4 people in the whole country who understood the situation. And these people were trying to figure out how to short the mortgage bonds. And nobody, it never occurred to anybody at Salomon Brothers or Goldman Sachs or anywhere. And when they finally said, these people are crazy, let's sell them some insurance so they can short it, they'll go broke. and they never caught on. I'm talking about the top, the elite of Wall Street never understood the risk they were in and thought these 3 or 4 people were just stupid kooks and would all go belly up. Of course, they all got rich as all get out, and Wall Street went belly up. Well, that shows you there was the power of, oh, this is a money train.
Yeah.
And it was so bad that just one bond trader in these big prestigious Wall Street firms could wreck the entire firm.
Well, you know, Paul, this is what I'm saying, that my perspective is that these people know, but they don't give a darn because they're making money up front. You know, it's just like the way they outsourced everything to China. Now, they had to know that down the road, this would undermine our own economy. But in the meantime, they're making tons of money, so they don't care. I mean, that's the way
they were told that this is what the Harvard and Dartmouth economists told them. Oh, no, these are just dirty fingernail jobs. They'll be replaced with much more productive and well-paying jobs. They'll be replaced, all these manufacturing jobs will be replaced with high-tech jobs, paying much more. I debated these people. I debated them.
Right.
One was at Harvard, one was at Dartmouth, one was at Columbia, Jagdish Bhagwati at Columbia. The Wall Street Journal showcased our debate. It was in the paper in segments. It went on for about a week, or at least several days. And I kept pointing out what you're pointing out. They couldn't see it. Oh no, this will make everybody in America better off. There's no downside to this. This was the line. This was the absolute line. And the facts didn't count because they were so convinced.
Is that because the insular thinking of the East Coast elite that's been in ivory towers all their lives and never dealt with the real economic reality in the outside world? Is that what it is?
I wouldn't know how to explain it psychologically, what was going on in their head that they couldn't see. But we still have people who think that the COVID shot works.
Yeah. And also, there's been such a curious lack of curiosity about the possibility that the virus might have come from a lab that was working on the virus just miles away.
Yeah, or it may have been intentionally released.
Yeah, I mean, dismiss the possibility out of hand. Oh, it couldn't be that.
Yeah.
I mean, at least look into the possibility, since the lab was working on the virus and was only miles away from the outbreak, and investigative reporters renowned with the networks and all that never gave it a thought.
Yes, they didn't give that a thought, and they also didn't give a thought that the lab was set up to be an excuse for an intentional release. Because you got to ask yourself, why did they have the vaccine developed before the virus?
Yeah, at warp. Yeah.
It kind of says, hey, wait a minute. How did they know this thing was going to happen? They had the vaccine and no virus yet.
Now, Paul, you're a conspiracy, theorist talking about those kinds of things.
Yeah, I know, but it's. But
I mean, yeah, the point is, this stuff is so obvious to at least be investigated, to at least be questioned as a possibility, and don't want to hear it.
Yeah. Well, when they offshored the jobs, they not only reduced consumer incomes because there wasn't any replacement for the $25 an hour manufacturing jobs.
Yeah.
But they also took away the tax base of the cities and states.
Right.
And don't you remember, Chicago was so broke it couldn't meet its budget, so it leased its parking meters to an Arab company for 75 years.
Oh.
And this meant then that Chicago couldn't have any more parades unless they paid the Arab company the lost revenues from the parking meters for the streets being closed. It's crazy. Why do people do that? What were they thinking? In other words, we're in budget trouble, so let's be sure next year we're in worse trouble. Let's foreclose our access to parking meter funds. Well, it makes no sense. Why would you do that? I would never do that.
In Scranton, Pennsylvania, the city was on the rocks financially, so they sold the parking venues to an outside company.
Yeah.
And a number of things like that go on. But Paul, this brings up the whole question. There's starting to talk again about getting jobs back to America. Biden talks about that, which is just lip service, since he was one of the cheerleaders to outsource the job to China and give the most favored nation status after pushing them into the World Trade Organization. But anyway, is it realistic to think that jobs can be brought to America back here as long as there's that wage differential between America and Asia? How could that happen economically?
Yeah, you could do it. I've been going on about it, for 20 or 30 years. What you would do, you would tax the corporations based on where they produce their output. So if they produce at home for the American market, they get a very low tax rate. If they produce offshore for the American market, they get a very high tax rate. So you could use the taxation of their profits to wipe out the labor cost advantage. And
they could still
this would bring them back.
They could still produce a reasonably priced product under that system.
They were. Look, Larry, no prices fell when they went offshore. The price of Levi's didn't go down. The price of Nike shoes didn't go down. The price of Apple computers didn't go down. Yeah. If anything, they all went up.
Yeah, the profits went up.
But so this was free market BS about, the consumers will benefit from lower prices. Well, not a single Nike shoe ever went down, not a single pair of Levi's, not a single Apple computer or iPhone. They never went down in price. The American people got nothing out of this except lower paying jobs and loss of pensions and medical coverage. That's all the American people got out of it.
But wasn't Trump making an effort through tariffs to get jobs back here?
I think that Trump never understood why the offshoring had happened. He didn't understand the arguments and the consequences. And I think he started jumping on China as protection against the charges that he was selling us out to the Russians.
Hmm.
So he wanted to show how tough he was. He's beating up on China. And I don't think he understood, what he's doing. It's not the Chinese fault that the American firms went there.
Right, right.
And you see, when the American firms, when they bring the Nikes and the Levi's and the Apple computers back to the US to market, they come in as imports. So that's where we get the huge trade deficit. It's all the offshore production coming home to be sold.
Yeah.
You see? So how could anybody have ever thought that this was going to be beneficial? Oh, we're going to double, triple trade deficit. That's going to help us. I mean, it just, I don't know. I don't know how to explain it, Larry. Is just a lack. I think something's happened to people. They're just not as smart as they used to be. How they ever could have thought offshoring. And not only that, Larry, there were economists, real good ones actually, who said this was free trade.
Yeah.
They didn't even understand free trade. In free trade, your capital stays home and finds its best use at home. If it goes abroad, it's not free trade. It's not looking for its comparative advantage. It's seeking absolute advantage. I mean, Adam Smith and Ricardo themselves say this. So I never understood how anybody could think moving all your jobs abroad was the operation of free trade. But that's what I had a huge debate in Washington about this. And oddly enough, at the time, the New York senator, who's so crazy now, came down, and he allied with me, and we took on the others, and we won the debate. And it was broadcast live on C-SPAN and then rebroadcast 20 or 30 times. Had no effect. And Schumer very quickly changed his mind when Wall Street went and said, "Senator, you're on the wrong side of this." He saw the campaign contributions drying up.
Exactly. But again, Paul, that's my point, that I can't imagine the people, or maybe the academics, are that naive, because they're in their own world of calculation and all that, isolated. But the politicians know the real world. They know how the economy works. To me,
No,
it's
they don't.
up to simple greed.
They don't know it.
They know darn well down the line it's going to be destructive. But in the meantime, they're making tons of money for themselves and their friends and their campaign contributors. So it's simply greed.
I think you're right about this for the business, for the corporate executives, for the top corporate executives. See, it takes all their working life to get in those positions.
Yeah.
They got 5 or 6 years to make their fortune. Okay. They can't be paid huge salaries because of the law that says if you pay an executive more than $1 million, it's not tax deductible as a business expense, unless it's performance related. So how do you get performance? You move your operations offshore, you drop the labor cost, you make more profits, that's performance, and you get massive bonuses. See, the pay of these people is in their bonuses. The bonus pays 3, 4, 5, 6 times the salary.
Right.
And that's how you, so once the Congress passed that stupid law, oh, it's not right to be paying more than $1 million, unless it's performance related. Well, then they start cooking the books in every way to make the performance. And so these people, yes, these executives, they got 5, 6 years to make the fortune. They behave exactly as you said. Now, the people in the Congress, they don't know anything about what's happening. They just know whatever they're told by staff or whatever lobbyists want them to do. In fact, the staff get captured by the lobbyists too.
Yeah.
Because if you're on the staff and you're serving the lobbyists and you have the congressman doing what you're going to leave that office and you're going to be making $1 million a year as a lobbyist.
Yeah.
So
door, yeah.
Yeah, it's all the notion that they're serving the public interest is not happening.
Well, wrapping it up now, let's get back to the banking crisis for a minute here. How long do you think it's going to take to see this play out one way or the other? Whether it's going to, the ripple effects are going to increase, widen, and have a dire effect nationally and maybe even globally,
Okay.
or it'll be contained. I mean, how long will it take for us to figure out which way it's going to go?
Okay, there's 2 things to watch, and one is whether the Fed abandons the interest rate hikes. If it doesn't, then it's going to continue to erode the balance sheets of banks, and the problem will return. The other part of the answer is nobody knows how risky these massive derivatives are. And as Michael Lewis makes clear in his books, it only takes the mistake of one bond trader. So one guy can blow up a firm. I mean, that's what happened to AIG, the huge insurance giant. It's blown up by one trader. So we don't know. It's no way of knowing. People, what are these? How in the hell would you even examine 188 trillion in derivatives? How much paperwork would you have to unravel? Who's on this side of the trade? Who's on this side of it? What's behind them? Who is this? It couldn't be done. So nobody knows what these risks are or what could set dominoes going or what kind of mistake somebody makes in his trades. I mean, all you got to do is read Michael Lewis on what happened on a much lower level of risk than today and see. It's just unpredictable. Anybody could have blown it up. And that's what, and the only people who understood that it was going to blow up were trying to short it.
Yeah. Yeah.
And nobody would even listen to their explanations.
Yeah.
They tried meeting with the regulatory authorities, the SEC, to warn, and it just got the cold shoulder. These kooks, they think the system, something's wrong with the system. This was now. So you asking me a question? Well, I'm just telling you, anybody out there could blow it up.
Yeah.
And so the real question is, why in the world do regulators allow this kind of risk to build? Look, when you do your program, go on my site and see. I think it's the Federal Reserve of St. Louis, the Federal Reserve Bank of St. Louis, that publishes the list of the derivative exposure of the 100 banks. and it's mainly concentrated in the top 5. They have almost all the derivatives. Now, everybody's got some, but instead of being multi-trillions, there'll be a few million or a few 100,000, you know. But you look at that, and you have to say, well, why in the world did regulators let a New York bank have $55 trillion in derivative risk when its capital is a tiny percentage of that? I mean, how do you do this? And then how can you say, like the Treasury Secretary said the other day, well, the banks are well capitalized? What is she talking about? You know, and is she intentionally lying? No, I think they actually believe the banks are well capitalized.
Paul, for the people out there who don't know how derivatives work and what the risk is, could you give a layman's explanation? A simple explanation, if possible.
You know, it's very difficult to explain it. In fact, it's very difficult ever to figure it out in the first place.
Right.
When you read Michael Lewis's books, you have to almost read a whole book to understand. But so it'll start with a mortgage bond. And then originally, the lender would hold the bond and make money on the interest that the bond pays, which is more than the interest he's paying depositors. Well, then they came along and said, look, we sell the bonds, and people will put them together in packages and market them as mortgage-backed securities. And then they said, we can turn this into a more complicated form of derivative. And then what do? Well, you see, there are different kinds of classes of mortgages. Some are really secure, some are iffy. So what we're going to do, we're going to cut them up in tranches. And this is the best set, and then this is the middle set, and this is the worst set. And then they become collateralized debt obligations, and we sell those, but then nobody wants the worst set. So they take the worst set and they do the same thing again. They divide it into AAA, B minus. Well, the AAA now consists of what was formerly the junk. You see, and the rating agencies were in on the deal and would give them ratings. So the bonds that were formerly in the junk class are now in the AAA class. And then somebody would say, oh, I know what we can do with the bad ones. We'll insure them. We'll get somebody to sell us insurance on them. Well, it just goes on and on. And so you had AIG thinking they're insuring AAA bonds and they're junk bonds. And nobody bothered to look.
No, just to unravel, I mean, it's such a house of cards.
You see what I mean? That gives you the notion. So, and of course, the rating agencies didn't, I mean, they went along. Nobody ever looked. And the three guys who looked, three or four of them looked, and they couldn't believe it. They said, this is impossible. It can't be right. Nobody would make these kinds of mistakes. This risk is unbelievable. In fact, a lot of them thought it couldn't be possible. They thought they must be missing something. So they go around to all these smart people and say, explain this to us. Explain. Oh, there's no problem. Nothing here. Nothing good. No problem. And they went to the Securities Exchange Commission. They said, look, what's going on? Oh, no, there's nothing going on. And they could see it's nonsensical. It can't be like this. It mustn't be. How could it possibly be? So they were even afraid to to try to figure out how to short it, because they couldn't believe anybody would produce a situation like that. Well, look, there's 3 or 4 people in the whole country that saw what was going on, and they almost never had the confidence to believe it could actually be true, because it made no sense for anybody to create risk like this. So, I can't answer the question. I don't know how many risks are in 5 banks holding derivative exposures that are twice the size of the gross domestic product of the entire world. I don't know. How do you get in that situation? How would you short it? I'd like to find out and short it.
Well,
all right, Larry.
My head is spinning.
uh,
So we'll
I tell you, the best thing to do if you really want to understand it is get Michael Lewis's books. Read Liar's Poker, read The Big Short, read Flash Boys. You'll see the most incredible, unbelievable stupidity, mistakes. They're inexplicable. They ruin the biggest firms.
But they were making money while the getting was good.
They were making money because they didn't understand what they were doing.
Or didn't want to understand.
They didn't know what they was doing. It's just like we didn't know what we were doing when we offshored all our manufacturing jobs. Oh, this is going to be good for everybody. Yeah. Baloney.
Well, Paul, to be continued. Maybe by the time we talk, the next time we'll be trading in beaver pelts. Everything else.
Yeah, I know. It's not really funny. It's a tragedy, but you have to laugh.
But you have to laugh.
And if I sit here and talk like this about it, it doesn't bring it out.
So a gallows humor at this point.
Sit here with a low voice like I'm in a board meeting, and you can barely hear me because I don't want to be assertive. I can't possibly be assertive. I've been in board meetings. There are people like this. You sit right next to them, you can't hear a word they're saying because they don't want to be assertive, because you're not supposed to be assertive. It's, the culture, everything. It's just, I don't know. Anyhow, you ask good questions, Larry. It's always fun to be on with you because you ask questions and they're the right questions.
Well, you've got such a vast resume and experience, and I don't know if people understand the depth of your knowledge and the degrees you have, and a lifetime of learning and examining the economic mechanisms. So it's a pleasure to have you on, Paul, and to be.
Larry, you're absolutely right. The kind of education I got is unobtainable. Nobody could get it today. The kind of education. I went to schools, universities when they still were. The kind of experience I've had, nobody alive.
Yeah.
When you put them together, yeah, but it makes it hard because people don't understand what you're talking about. So anyhow, we'll see. I think that a lot of human capital has been wiped out by the decline in the institutions of learning. They're all into diversity or rainbow colors. And I think that prudence is gone. you know, a bank, a Wall Street firm, a bank. These were people who were prudent, that tried to be, because the risks are there, and they can eat you up and ruin you, and ruin your customers and the community. And in place of that, now we got casinos run by drunks on drugs. You know.
Literally in many cases.
Okay.
All right, Paul. Thanks very much. To be continued.
Oh.
Thanks, Paul.